So you make your trading choice and you live by the saying, whatever will be, will be. Now it's easier said than done, of course, but an extremely important part of finding any success in this business. So what does this mean? It means to stand by your choices that you make in your trading. Assuming you know what a pennant is, let's say that after scanning a few charts, you see the pattern emerging and after reviewing context, decide that this is a trade that you want to take. So there are a few questions to answer, including where to enter, where to stop out, and when to take profits. These three questions must be answered before entering the trade, and without knowing them, you should assume that you don't have a possible trade. So number one, where to enter. While there are many methods for pinpointing entries, it does not have to be complicated. Some will play the breakout, some will play rejections or a new bar high, while others just get the trade on. Number two, where to stop out. If you don't know where to exit if the trade's a failure, how will you ever consistently manage risk? You often hear to place your stop where you'd be proven wrong, but that area can often be played by the bigger money. And number three, when to take profits. Lots of options here, including one, time the risk, then your trail, chart pattern, structure, etc. So on this chart here, you come across the following pattern. Now, whether or not it fits the exact definition of a pennant, it's meaningless. What matters is if it exhibits much the same action as the textbook definition. A, we have solid strength in the run-up to the pause in price. Is that important? Well, it's not a 100% guarantee of a continuation in the up move. The odds favor a continuation once the pattern resolution occurs. Now B, the up move does not appear to be a climax in the up move. And C, the formation of our pattern. Now some traders simply buy into the pattern when it starts the tighter consolidation as shown with label number 1. Other entries can include the actual breakout at number 2, the breakout of the open of a candle at 3, or, not shown, a failure test of the base of the pattern, or a break of a consolidation on a lower time frame. Now the protective stop placement, stops can be a little tricky as you want to ensure a decent position size while ensuring you're out when the trade's no longer valid. Now many traders will place it just under the low of the pattern as shown by the red line. Well, the problem is many traders would place their stop there, so it's easy running, plus a price poke below does not invalidate this setup. My choice is the blue line, which keeps it out of the noise of the market, although neither of these stops were challenged in this setup. Profit taking has many options, such as scaling out equal to risk, leave a runner. What matters is the consistency of what you do. So once you have your entry criteria, your escape if the trade goes against you, and how you'll take profit, the next step is the hardest. Leave the trade alone. But that's exactly what you have to do. So here's an example. After a sloppy run up in the Euro-US dollar, I sell stopped and I was triggered into the short. I had a scale out target equal to risk that left no risk on the table of the trade. Price missed the scale out by about 50 pips and it started to move back up to an area that was showing resistance and started to challenge my stop. Now the green candles were certainly larger than the previous red, and I honestly had to fight the urge to save a few pips and mark it out of the trade. I had to resort to whatever will be, and since I had already accounted for the risk on the trade, it would have been a loss amount that fit my overall plan. Now that said, while the reversal type candles didn't really justify an exit, the first green candle did, as it appears to be momentum against my position. If I was actively managing this trade, that would have been an exit to be comfortable with because the point of a swing trade is to take one clean swing in the market. The green candle ruins the clean swing aspect. Now the trade has since recovered and I had to add the scale out back in as the order had expired. Now the question is, what happens if this move fails again? Well, whatever will be is a great mantra. It's hard to ignore an obvious change of state of the market. Trying to be consistent is job number 1. However, blindly following a rule when all objective signs point to an exit can erode much sought after profits that oftentimes are pretty hard to come by. Get your trades on and just let them play out. That is, until the run for the exit begins.